some great trading days. And this is the year of 2020. We go to the doctor, and ever since we've been going to the eye doctor, right, it's always been about 2020 vision. And so we've had some testimonies, right? We've seen BYOB cash out, call out. We've seen the testimony that I left my job. I put in the 2-week notice, and those are real, okay? Those are real. So if you're just joining us, you're joining us for the first time, you're new to BYOB, let me get a 111 in the chat. Okay, let me get that 111 in the chat. If this your first time on a BYOB call. If you are still learning how to cash out, you're still new to the BYOB system, let me get a 222 in the chat. And I'm gonna add something else. I'm gonna let me get a 333 in the chat if you've joined us since the holidays. And we started back up with 2020. Okay. To each and every last one of you all, I want to say welcome. You know, especially welcome to you all who this is your first time on a call. This is definitely a training call this evening. To those of you all who are still learning, let me get that 222 and that 333s. I want to welcome you all. Now, this is important. You're learning a skill set. We're on here tonight. We're definitely going to walk you through how you can cash out. I'm going to walk you through how you can definitely do the BYOB cash out. I want to walk you through that. So definitely want to make that happen. But I know one of the things when I started trading, it was about how many pips a day could I grab. It was about, I started at, I can get 20 pips a day. I felt fantastic. And it progressed to, okay, I'm doing 200 pips a day. It just felt phenomenal. But you really want to take that and you want to learn proper risk management. You want to learn how do I walk off of my job if that's your goal? How do I fund what I want to fund if that's your dream and if that's your goal? Right? What is my proper lot size that I should be using for whatever your trade account looks like? What is it that I should be using? What is it that I should be going? Right? Because I mean, just like everyone, someone's going to tell you the recommended lot size. Someone's going to tell you the recommended growth. Someone's going to tell you what they believe. You need to know what it is for you that you want to do, because when I've been, that financial advisor, that's my background. And every time you sit down with a client, that is personalized to that client. So why would my trading lifestyle be personalized to that person? It's no different. It's gonna be the same. So it's going to be, so when you sit down to do your retirement accounts, your retirement funds, you sit down and do any of that, it's personalized to you. So your trade account needs to be personalized to you as well. But I want to show you exactly how this can be personalized to you. So we're gonna go, what you see on this chart, this is in the Facebook group. So this is in the Facebook group, and you have the opportunity to grow your account. This is in the files, BYOB Cash Out Facebook group. Now, when you go grow your account, do I want 3% growth? You need to play with this. You need to understand that we're going to do 3%, right? We're going to do 3%. Now, you see I had it at 5%, but I'm changing that and I'm going to put 3% on here, right? This is what we're going to work with tonight, is a 3% growth. So when you fund your account, my first example is going to be at $500. If I begin and I fund my account at $500, now this is per trade. You notice this says trade, not day. Now, when I do trade, you have individuals that do just 2 trades a day at 10 pips. And properly compounding, I mean literally 2 or 3 trades a day. 10 pips, cash out, proper discipline. And yes, I said it more than once, 2 or 3 times on purpose, because when you remove the emotion and you use that proper discipline, then you literally can compound and build your account, okay? And this is how that's done. So if I am building, and this is one trade, okay, when I'm doing that at a 0.15 lot size, because at a 3% growth, and then I go to a 0.15 lot size, I grab 10 pips, and yes, it might be great. You see us on the calls, you see everyone grabbing, oh, I'm 20 pips in profit. I'm 50 pips in profit. I'm, we're 100 pips. I mean, whatever it is, okay? Are you following your risk management? What are you doing? Because when you do that, then guess what? On that trade, I made $15 because I did what I was supposed to do, okay? Then, now you notice I'm in this column. I'm in this column because I'm doing 10 pips and I'm cashing out. That's the foundation of the strategy. That's the foundation of BYOB cash out, okay? That's where we begin. That's where we learn from. Now, continuing to do that, we funded this account with $500 right here. Now, continuing to do that, okay? For each successful trade, I have a successful trade. You notice my lot size is still at 0.15. I have another successful trade. I move it up to 0.16. It's not a guessing game. This is a compounding sheet. This is how you grow your account balance. Now look at this. So let's just say you did one trade a day. At the end of 30 days, one trade a day. Now these are successful trades. So let's say I hit a stop loss, because nobody's perfect. If it takes me down, then what's my balance? Okay, let's say I hit stop loss somewhere around here. Somewhere it takes me down to this balance. Then guess what? All I do is I look at, okay, I got about $800. So then that's just where I need to be. My lot size is 0.23 because my account balance now is at $800, right? This is my account balance. It's not, or 802.35. I'm saying 800 because if it was 800, then I would be here. I'll be looking here. It's higher than here. And I would stay at this 0.23 until I reached 802.35. Once I reach 802.35, then I'll move up, right? So that's because I hit stop loss. And then I'm gonna keep moving. I always wanna make sure I maintain it. And this is how you properly compound. This is how you properly compound. This is how you do that. So at the end of those 30 days or 30 successful trades, you now have $1,200, $1,213 in your account, okay? So if I was doing 2 trades a day, and I started, remember, I started with $500. At the end of that, I now have $29.45. So let's 125 trades. 125 trades. I have $20,000, okay? Do you know the average person makes $32,000 a year? The average person makes $32,000 a year. We're not talking about a year. We're talking about 125 trades. So depending on how many trades you decide that you want to do a day, right? So if you did 3 trades a day, that's 41 days. Oh, 41 point whatever. So that's like 40, about 41 days. So you just made $20,000. So yes, you're changing your life, okay? You're changing your life through proper compounding. This is why you always hear me say compound, compound, compound. Go see the compounding sheet, get the compounding chart. Now, you start your account with $100, okay? If I start my account with $100, and this is 3%, I'm not even a heavy risk taker. I'm at 3%. Look at I'm at a 0.03. This adds up. I made $3 on this trade. But look what that $3 does, it grows. So at the end of that, okay, those same 125 trades, you now have $4,000. So it still adds up. But this is what I want to show you. Why do we begin the BYOB cash out on a 15-minute chart? Why is everything built from there? You should not even be A lot of people start their accounts there. You should not even be trading more than 10 pips until you have your account balance. Look where it says, if I'm trying to go, you know, my take profit 73.98. Look right here, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0, 0. So all this is zeroed out. So I should not even have, right, when we're trading, and I'm saying, look at your take profit, look at your account balance. You know, if you, based on your account balance and where you are, you should not even be, should you even be going for that take profit 3? Because I'm going to show you again tonight what we've been talking about, how you get those pullbacks. This is a 0 because your account can't handle that pullback, and it will knock you out of that trade. So do you see that even though we're going for 10 pips with the same spreadsheet, you have to have a lower lot size. On 10 pips, I have a higher lot size. So regardless of your style, look at this. I have a higher lot size for 10 pips, a lower lot size. So you still end up in the same exact place. So you can do 10 pips and cash out and be very successful. So somebody who gets 200 pips a day and somebody who gets 10 pips a day, they're still walking away from, if you're using proper risk management, if you're doing this correctly, you're doing this properly, you're still walking away with that bottom line. And that's what this is all about. It's not about the big, it's about the bottom line. It's about building your wealth. That's what this is about. It's about the wealth that you're looking to build. So let's talk about that person that says, you know what, I'm gonna put $2,000, because everybody's in a different space, right? Everybody's in a different space. So let's talk about that person that puts that $2,000 in their account to grow it. So you put that $2,000 in your account. Even still, that doesn't mean when I go longer, I get a bigger lot size. No, my lot size, if I trade longer trades, my lot size is still lower. Look at my take profit, okay? Look at my take profit. I mean, look at, for 10 pips, my lot size for 10 pips, not my take profit. So well, it's still a 10 pip take profit. That's what I was trying to say. So, but look at this. So my lot size is still smaller, right? So now, at the end of 30 days, I've taken, it's moving kind of fast. I've taken that, now I've turned that into 4,800, okay? And at the end of that 125 trades, let me say successful trades, you've now turned that into $80,000. So can you see how this can change your life through proper compounding compared to if you didn't know anything about this? If you didn't know anything about compounding, if you've never used a compounding sheet, if you've never touched a compounding chart, if you didn't know anything about it, can you see how this can actually change your trading from here on out with clear vision? If you are there with me, let me get a 555 in a chat. $1 million families, financially educated and impacted, financially empowered. That's what this is all about, okay? That's what this is all about. Now, I want to show you something else, okay? And why do we say US 30? Notice these are pips, right? These are pips take profit, okay? These are pips. So if I'm talking about a 10 pip take profit, notice, so what do I need in my account? What do I need in my account? Let me go back to, so if I'm looking at this, okay, I'm doing a 10 pip take profit, a 10 pip take profit, okay? This is 73 pip take profit, okay? If I go to, let me change my, so just keep this in mind, okay? This one says 73. This one says 98. Now these are pips, okay? These are pips. So if I go to the vibrata, So let me change my share for you for just a moment. I'm gonna change my share. So this is the US 30, right? Now let me run this over this for a minute, okay? I'm gonna run this over this for just a moment. Let me run this tracker. This is why, if I start here, and I'm gonna pull this over this, okay? Now look at this. See, this is measured in points. And what you're looking at is 16 points, right? Roughly about 16 points is what you're looking at. But on this side, if I had to, this ruler measures pips and points, because if I take this to a pip chart, if I take it to a pip chart, right, it's gonna measure, if I take it over here, it's gonna measure, right? It's gonna measure, it's not a lot of volatility in there right now, but it's gonna measure pips. So notice that, you notice that this is pips on this side and this is points. So there's obviously no point. You look, you know, like look at what it is, right? So this is pips, 4 pips, and this, look at what it is. So obviously, 16 points, 163 pips. We don't measure this in pips, it's measured in points, but I'm gonna make a point to you right now. If I wanted, where is 163 points on pips on that chart? We just did 10. So if I wanted to do 10, okay, I'm just showing you it's the same ruler. If I wanted to do 10, are we gonna trade it for 10? This is why when we're talking about trading the US 30, about what your account balance needs to be. So when someone's telling you, and this is just for understanding, so I can't even get it to 10. So when someone's telling you, I might have to go down to the minute chart, that you need like $1,000 in your account, probably still can't get it. There we go. You need like $1,000. Look how much move. I didn't even move a candle. I didn't even move a half a candle. That's what you can trade with proper risk management. Just that fraction of that candle. That fraction of that candle is what you can trade with proper risk management. Because for 10 pips, that's 10 pips, which is really just 1 point. So with that account, that's what you can trade with proper risk management. So this is why, you know, when we're talking about trading the indices, when you want your account balance to be built up, or you want to make sure that you have, because this moves so much. And so when you go back to this compounding sheet, that's why you want to have that balance in your account before you start trading indices and anything else. So is, you know, do I have any question? Let me go, because I was changing my screen share. You are so welcome. You're so welcome. So do I have any questions before we move on? Do I have any questions or any comment? Well, it's because, you know, you're right. It is a big jump. They have a lot of different compounding sheets out there, and you can find them in different places. You know, this one I tailored a little bit, but I'm not gonna even pretend like, you know, oh, you're so welcome. But they just have so many. They have so many out there. And so this kind of is tailored to, oh goodness, where? I have no idea. But I did tailor this, but they just have so many. They have so many out there. I'm glad that this did help, though I am glad. So. Let me see. Any more questions? You're welcome. Now, where do you get this one? It's in the BYOB. It's in the BYOB cash out. BYOB Cash Out Facebook group, and it's under files. That's where you can find this one. That's where this one is at. And you can download it. And when you download it, it's actually, you can change your amount right here. You can change your growth percentage. If you're on the low side, you can change it to 2%. You know, you can change it to 3%, 5%, whatever your percentage is. I had it on the average, which is about 3. So it's all in there. So wherever you want to start, but it's all there. It's all right there for you. So any more questions? Because I want to, it's something else I want to help walk you guys through. But I want to make sure you understand this, because this is where your money is. This is how you say, you know what, 2020 is my year. You know what, this is it. Go ahead, Mr. Rogers. Was that you? Or was that somebody else? Okay. So let me go back to, no, you want to do that a month. What's considered a high risk growth? 10 to 12%. So let me show you. You want to do that a month, not a trade. So if I did, let me just show you. Okay. If I did a 10 to 12% growth, right? 10 to 12%. So what's considered a high risk growth? So 10 to 12%. So when we say you can grow 10%, that's like a month. So if I did a 10% growth, now yeah, I got $50 on that trade, but you also want to consider, you know, the risk to reward ratio. So that is going to be, once again, that's going to be personal. That is definitely going to be personal. That's going to be, you know, if I'm going to make $50, I'm doing 10 pips. Now, what that is also telling me is that I got a 15 to 20 pip drawdown. Now, this is typical. This is a typical 15 to 20 pip drawdown. However, when we look at the BYOB cash out, sometimes it might just be 8 pips. Your stop loss might be 8 pips. Your stop loss might be 10 pips. Your stop loss is not always 15 to 20 unless you're trading those GBP pairs, right? GBP pairs is where you might be a little bit outside of this range. So you want to play with it. You want to demo and get a feel for the currency pairs that you're trading, because the only ones that typically are really outside of the range, depending on when you're trading, is the GBP, because of the volatility that's in those pairs in the markets. But as we know, we can also get more than 10 pips as well. But you want to make sure that you want to apply this chart, and you want to make sure that you understand it. So does that make sense? Does that answer your question? So you don't want to do that on a GBP pair, because that they also have a strong pullback as well. So, and you don't want to allow yourself to get knocked out of a trade. No, it's always a good time to trade GBP. It's not necessarily a good time to trade a certain currency. It's always a good time to trade the currencies. It's just, you just have to understand the liquidity and volatility that's in the market and when it is. There's a training also that's in the playlist that talks about the liquidity and volatility in the market. So that'll be a good training to go back and watch. That kind of explains the liquidity and volatility in the market. That will really help you with that too. So we definitely spent some time going over that. Make sure. Okay, so let's talk about what I really want. I want to explain the BYOB cash out, but what I really want to do is I have the harmonic scanner up as well. I want to give you all some homework. So I'm going to talk to you about the BYOB cash out. but then I'm going to give you some homework. I promised that we would cover support and resistance lines. So these support and resistance lines, oh, you're very welcome. You're very welcome, Juanita. These support and resistance lines, it will help elevate your trading. So if you are looking for more than the 10 pips, if you are looking to do a little bit more, then the support and resistance lines are going to elevate your trading, and they are a necessity. Time frame confluence is very important. Time frame confluence is very important in understanding the trend of the market and the swing of the market. So that's definitely something that we covered last Tuesday. So this is really like that next step. Now, I can understand time frame confluence. Like, I can understand where the market's going. I can understand what it's doing. Now, what I'm going to do right now is I'm going to get rid of the stochastic, because I just really want to paint this big picture for you, right? I'm going to kind of get rid of that. I just want to paint, I want to paint this picture for you right quick. Now, we're going to look at this GBP AUD. Now, look, if I look to the left, now I'm going to just go to the daily. So looking at what this currency pair is doing overall. So honestly, this one has been buying, right? It's been in that nice uptrend. But what is it doing overall? Like, what is it doing? So in this movement, right, you can see different market structure, you can see shapes, you can see all sorts of things. But we're not on this call because we're swing traders. If we were a swing trader, we would have set this and we would have marked it up, we would have looked at it, we would have walked away from it. I mean, this is August and now we're in January. So, you know, over the duration, over the time frame, you can kind of see that it's moved up, right? It's been in a nice little uptrend. So you can kind of see, okay, head and shoulder market structure, what does that mean? It's turning around overall. But that's not what we are. But that does help you understand the big picture of the market, okay? Helps you understand the big picture. But within this is important, okay? What is the market doing today? Okay, the market was selling yesterday. The market today, okay, the market was in a sale yesterday as a whole, but today it looked like it's pulling back a little bit. It looked like it's going into a nice little, it looked like it's pulling back into a buy. That's still important. Now, when I'm looking at, so when I'm looking at the trend of the market and the swing of the market, right, overall, today, when we're looking at, let's change it back UCC. When I'm looking at what I've been looking at, it look like it's kind of been in a buy, okay? It's kind of been in a buy. But what we want to do is, so we understand swing of the market, the trend of the market, the swing of the market, we see what it's doing, but how do I know when is it going to turn around? How do I know, those reversals? How do I know when it's going to happen? Every single time. Now, you see I'm on my 4 hour right now. So between my hour and my 4 hour, every single time that the market hits one of these structures, it does something. It pauses and it makes a decision. It pauses and it makes a decision. And it doesn't always pause. It doesn't always pause. We talked about the PSAR. When that PSAR is riding those candles, it doesn't respect that pause at all. It just busts right through it. It just keeps going, okay? But every single time but we're just gonna look at those pauses, those main pauses, it does something and it makes a decision. Do I turn around or do I keep going? And when you understand that, you'll understand that, okay, when you get there and you understand that, you'll begin to understand those buy stops and those sell stops and those buy limits and those sell limits a whole lot clear. We're not there tonight, but we'll get there again. And, that'll become a lot clearer and, it'll make a lot more sense to you. But so what I want to do is I want to help you understand that, because understanding all of these factors together, understanding all of them together is really, really, really going to help you. Okay, it's going to help you. Now, when you look at this, you're looking at this, you're like, oh my God, that's an EKG. I had someone tell me that, and it was the funniest thing I heard. But in reality, it's really a lifeline. I mean, it is your lifeline. This and that compounding sheet, this chart and that compounding sheet is your lifeline. So, funny or not, this is, hey, I'm gonna go with the EKG, right? So, but let's dissect this for a minute. I'm gonna go back to the hour. I'm gonna go bring this back to the hour. So now, what I want to do is, matter of fact, I'm gonna just leave it here. Mr. Rogers, you unmuted. You want to add something? I don't know if he's unmuting on purpose or, okay. I'll just keep going. If he got something, he'll add it. So I'm still on the 4 hour right now. The hour to 4 hour, whichever one is fine. So now, so what you want to do first is you want to go to the line chart. When you go to the line chart, this should get a lot clearer. Okay, it should get a lot clearer. So notice the difference. Okay, notice the difference. So notice the difference. Now look at these lines. Okay, these with the line chart, these are the closing prices. So Hikinashi candles, when I go from my Japanese candles, so you got all the noise and all the confusion that happens between the buyers and sellers, to strictly the trend, the up, the down, right? Just strictly the trend, to just the close price. So look at how smooth that is, okay? Look at how smooth that is. So now, let's see. If I take my line, and if I'm just looking at these touches, okay? I'm looking at these touches. If I drop the line where my touches are happening, I really do probably should be on the hour because I want to get the major ones. So if I drop the line, okay, look at where these major touches are happening, okay? Now remember, this is an art, it's not a science. You're not gonna be dead on, okay? You like where I might drop it here, somebody else might drop it up here. So don't get somebody else might have it right here, you know, so don't get so technical that I don't want anybody to say, oh my goodness, I didn't do that right. So I told you I'm gonna give you some homework to go practice. I'm gonna show you how to check it, okay? So, but what you can kind of do is kind of look to the left to kind of see because a support line, this is why you always hear me say it's a support and resistance line. So a support line, when the market's coming down, it's a support line. When the market's going up, it's a resistance line. So if it's got touches to the bottom, then over here it'll have touches to the top, right? That's what it'll have. So you want to look at those major touches. And so you can just kind of grab a few lines and you want to draw your support and resistance lines, right? And you want to do it on a higher time frame. You definitely want to do it on a higher time frame. So you see that I have some more. You see I'm on an hour chart, and I'll actually move this one down just a little bit because I see that right here it's a resistance point, but then over here it's actually a support line a little bit, but then I have it where it's getting choked up right here, and I call it a choke point. That you hear the logistician in me, but you see it's got the choke points right here. So that's where that term come from. You won't find it in any Forex thing you ever study. So now you turn around, you hear that. So you turn around, you look for those same choke points, and you just looking at, you see all those touches. So, and you see some more, but I'm gonna just stop right here. You know, I don't want to have it looking like a coloring book. So then what I'm gonna do is I'm gonna turn around and I'm gonna turn this back. Okay, and so when I turn it back, then Of course, you can start kind of make some adjustments, right? You can make some adjustments that as you need to, okay? Make some adjustments. So you can kind of see that they will have some here. And depending on how many pips is in between here, right? That's like 64. It's not too bad. So, you know, make the adjustments as need be. What I wanted down here, when I'm looking at knowing that your trade will be going there, your trade will probably get choked up right here. It'll probably get stopped. So what I want my trade, what I really want my, because remember, these are your take profit ones, your take profit twos, and your take profit threes. So would you want it up here knowing that you might have some hesitation, or would you want to have it down here? Where would you want your take profit? So remember, it's all personal to you. Where would you want to put it, and why would you want to put it there? So knowing that, that's kind of how you do that. Now we want to drop down to the 15-minute chart, go back to where we were. Now, why do we mark it up on a higher time frame? Now look what happened when we drop down to the 15-minute chart. Look at all these little dynamic lines, right? You will really have a coloring book if we did it. See, you got a little line right here. I got a little line right here. I would have lines everywhere. I don't want to mark all these lines up. It's probably going to push through those lines, right? So you will have lines everywhere. Okay, let me delete that one. So, but this is how you draw your support and resistance lines. So, but those support and resistance lines are important. Now, but do you notice that when you have those support and resistance lines, notice how it came down, it got stuck there. See, it's like a measured move though. It got stuck there, but it still kept going. So it's not that it stopped the flow of what was happening, but the market kept going, the market kept moving. So, and every single time it gets to one, you get some pullback. So even someone dropped it in the chat about a trade that she was looking at in a trade, right? So the market was moving up, and guess what it did? It came down, it pulled back, it tested the line. So every time you're in a trade, every single time it gets to it, and let me not say every single time, because there are times that it will push through. So there are times it will just push right through it. But for the most part, when it gets to a support and resistance line, you're going to get that. And so this is to help you from saying, hey, can you check the trade? Look at this. What's going on with the trade? What about my trade? Hey, it's in a negative right now. What's going on? Or why did it pull back so much? Well, now you know why it pulled back. Now you know what's going on. Now you know what's happening. What's happening is at a checkpoint. It's at a checkpoint. It's at a support and resistance line. That's what's happening. And so even if I have time frame confluence, even if I have those things, like I'm gonna put my stochastic back up here. You look at the hour, so this was pushing up, but if I look at my 4 hour, the 4 hour is still in a nice uptrend, right? The 4 hour still got a nice push up. So this was, you know, this was pushing up. So that hour look like it's kind of stuck right there now. But this did have an uptrend when she was looking at it, right? But that 4 hour still has that nice push up. So what happened? What happened is it's kind of stuck at the support and resistance line. So does that help you understand what the support and what the resistance is? Because you're gonna build from this, but I cannot stress to you how important this is in your trading journey. Does that help? Let me get a 555. Awesome, awesome. Any questions on this? Any questions? You say you checked it again today? No, I do. I mentioned a day. I started at the day. But Do you know? Okay, that's a good question. So the question is, why not use the day for the trend instead of the 4 hour? So when you're looking for, there's something called a factor of 4 to 6, right? There's something called a factor of 4 to 6. So we're trading off the 15-minute chart, and then I'll give you kind of your homework because I want you to practice those. Correct. So we use the support and resistance lines to stay in the time frames longer. Correct. So there's now. So for let me explain this and I'll answer that next question. So if I'm trading on a 15-minute chart, there's something called a factor of 4 to 6. Factor of 4 to 6 means that I'm going to multiply by 4, 5, or 6, and that's going to take me. So if I multiply whatever time frame I'm trading on, 4, 5, or 6, then I'm going to multiply by 4, 5, or 6, and that's where I check my swing of the market. Okay, my swing of the market. So my swing of the market, I'm looking at the hour. So whatever way my candle is going, that's my swing of the market. So right now my swing of the market is in a buy. My swing of the market is a buy, but my buy is stuck at a resistance point. Okay, my buy is stuck at a resistance. My swing is stuck. Now my trend of the market is in a buy. Okay, my trend of the market is in a buy. So knowing that, look at my stochastic, okay? My stochastic is still pointed up. I still got my stochastic moving up. So we just got this 4-hour candle. We just got this. So we still have 3 hours in this candle, okay? We still have 3 hours in this candle. So it's still pushing up. So it's still in that buy. Now, what you asked me about the daily, the overall, okay, the overall movement, right, of what's happening when we first got started, I did look at the daily. Now, the overall movement, but the overall movement isn't a buy. So if I was swing trading, or if we were trying to go for 200 or 300 pips or 100 pips at a time, or, we were trying to do trading like that, then, right. So if we were trying to do trading like that, then yes, we would definitely be looking at the daily. I mean, look at all these different things that we can look at. Let's just check some stuff. I mean, there's so much stuff in here, right? I mean, you're looking at the monthly or my swing trading. So it's so much stuff, but we don't want to get into analysis paralysis. So my weekly, my daily, I mean, you got a 2-hour. It's so much stuff in here. My 2-hour is up, my 3-hour is up, right? But you can overanalyze too, I can overanalyze. But my daily, what am I actually, is my daily gonna help me grab 10 to 50 pips? If I'm looking at this, it might be going for a buy, but I'll miss my sell opportunity if based on what I was looking for, because I wouldn't have took that sale down there. I wouldn't have took it. So it's just so much. So yeah. So the swing, yes, the hour is a swing in the market. The 4 hour is the trend of the market based on what it's doing. They're both confluent. And you notice that we're not pushing for, now if you got all of them together, then hey, you're doing good. But so I'm not saying don't look at it. I did look at it. You'll see me sometimes when I'm flipping through the chart. You'll see me look at stuff. I'm not saying no, don't ever look at that. You'll see me look at stuff. So, but what I'm saying is when you're sitting here looking at this, and I got my hour and my 4-hour confluent, then I know what I can go look for. But you notice that we're trading on a 15-minute chart is where most of our trades come from. So most of our trades come from. So we're really looking at that market structure. We're really looking at it to close the gap on that market structure. And so we just happen to be on this one. And how many pips would this be? We're typically not going for 156 pips. We just happen to be drawing support and resistance lines on this chart. So a lot of the trades that we take might be anywhere from 30 pips, 60 pips, 10 pips and cash out. So we 40, 50, those are the types of trades that we've been taking. But if I'm doing 156, oh yes, I'm looking at the daily, right? If we're trying to close this gap, I want to know what's happening because I'm not taking 156 pips or trying to mark up for that many pips without looking at the big grand scheme of things. So yeah, if I'm gonna mark this up to go that high, then I'm gonna look at a lot more than just the hour and the 4 hour. So we look at support and resistance lines only the higher time frame. So no, if you're doing more than just scalping, so if you're just doing like 10 pips, jump in and jump out of the market, if you just want the foundation of the cash out, which I need to show you guys real quick, if you just want the foundation of the BYOB cash out, which is 10 pips cash out real quick, then then just stay there. I do need to show you guys the BYOB cash out real quick. Then the rest of it. But if you're doing more than that, you need to understand support and resistance lines. You really do. So the BYOB cash out is designed and developed for anybody to be able to learn how to trade. Anybody can learn how to trade with that. So and it's for anybody as they're learning the skill set. So you're learning what we're teaching you tonight. So while you're learning that, you can be 10 pips cash out, compounding, building your account while you're learning all of the other stuff that goes along with it. So it also helps to look at the lower time frames too, to see the pullbacks after I enter the trade, so I can determine whether to pull. No, let me show you the cash out, because you should not be looking at the pullback to say, oh my goodness, I need to get out of this trade. You should be riding a wave to understand how the market moves. You should just be riding a wave and trusting your analysis. So let me see. So let's see here. Well, so this is what I want you all to do, okay? Really quick, and I want to show you the cash out. So here this is the harmonic scanner, okay? Got a few minutes left. So how we just happen to be on that one. I need to refresh it and get a fresh trade. I need a fresh trade. So so really it's not even about the trade, okay? Honestly, it's not about the trade. So this is what I need you guys to do, okay? So go to the hour, and this is just for practice, okay? This is really just for practice. So now, just for practice, this is your answer key. Remember when you were in school, because the only way you're gonna learn how to do this is get in the water. You can't learn how to draw and mark it up by watching me. So this is homework. It's really homework. You got some homework. You got to get in the market. You have to get in. So this is the harmonic scanner. Do not even worry about the trade. Like, I'm not even concerned about the trade right now. What I want you all to do is understand that each one of these lines are nothing more than support and resistance lines. So remember when you had a key, remember when you had a book and it was the answer keys? That's what it was. It was answer keys, okay? And at the back of the book, it was answer keys. What I want you to do is not look at your answer key. I want you to come to the harmonic scanner and just come back to the vibrato, punch in the currency pair, right in the currency pair. You kind of look at the formation. Now, of course, it's going to look a little different, okay? This is the 15-minute chart. So it's going to look a little different because let me go to the 15-minute chart. It's gonna look a little different because we have Hikanashi candles. They do not have Hikanashi candles. They're using the Japanese candles. So it's definitely gonna look a little different. So don't worry about that. I'm just concerned about you looking at this and then comparing the numbers to kind of where they are. Now, what I want you all to do is just do a few of them, do about 5 of them, and go to the line chart, go to the line chart, go to the higher time frame like we talked about, mark up your support and resistance, bring it, or bring it back, or even if you do it on a 15-minute chart, I've explained to you why, but I'm comparing it to the 15-minute chart. So I really want you to understand where we are and why we're there. And I want you to draw your own lines first. Draw your own lines first, because the answer key is in the back of the book. Draw your own lines first, and then go here, write the numbers down. And so don't worry whether it says stop, entry, or whatever the case may be. Write your own lines first and then come back and see how accurate or how close you are. That's what I need you to do. So with that being said, let me show you the BYOB cash out. We don't have time to do one because we just spent some time marking it up, but you will see how close and how accurate you are. So let's talk about the BYOB cash out real quick. I'm gonna just change these to Hikanashi candles, and let's talk about what the BYOB cash out is. You're welcome for your homework. So what the BYOB cash out is I'm on the 15-minute chart. You always want to make sure you're on the 15-minute chart. So with that being said, we will always want to start with the stochastic, okay? Always want to start with the stochastic. It runs from 0 to 100. There are something called leading and lagging indicators. This is a leading indicator, meaning that with this being a leading indicator, that means that it happens based on, based on the patterns. Just think about it, based on patterns and what typically happens when these patterns happen. This is what we believe is about to happen. So every day you got a pattern, you're doing something, right, that, you might travel the same route to work every day. You haven't put your blinker on, you haven't done this, but based on your patterns, I believe you're going to make a right turn when you get there. That's what the stochastic is. Based on the patterns, based on what's happening, I believe you're going to make a right turn. So based on the patterns, based on what's happening, I believe that the market is going to go for a sell right here. So when that blue line crosses over the red and that downward momentum, when that happens, then this is actually happening. This is going for a sell. Now, these are lagging indicators, meaning that something has transpired to tell you that this is going for a sale. So that means that you've actually put your blinker on. That means that something has happened in the market to say, hey, we're going for a sale. Something has actually transpired in the market to say that it's going to sell. So that's what this is. These are trend candles. So that's why we use these and not the Japanese candles. These are trend candles. And then these PSARs show reversal in the market. Most of the time, you'll get this PSAR flip afterwards. So that's not, you notice that this one flipped first, but most of the time you'll get that afterwards. So really quickly, for the sake of time, I'm gonna put this candle here because I'll put the arrow here. This is what we honestly will be looking at. Now we want this crossover to happen around the 84 sell, around the 24 buy. Now, I need red candles with a flat top for a sell. I need the PSAR at the top for a buy. So if I was looking for a buy, of course I'd be around the 20 with the crossover happening. And then I need a green candle with a flat bottom. And then I need my PSAR flip to the bottom. Of course, this one is not close enough to the 20, but I'm just kind of showing you a quick example. So here we have it. Now, what is time frame confluence? Time frame confluence is, I would look at my 5-minute chart. My things are not marked. I will go to my 5-minute chart. When I flip down to my 5-minute chart, this would need to be selling. This is how, to answer the question that I was asked earlier, this is how you're talking about entering for pullback. Because my 5-minute is still selling. because 5 minute happens before the 15. If my 5 minute is happening before the 15, my 5 minute is still selling. That helps me know that I'm not entering in a pullback. So I know that I'm not entering in a pullback, so that definitely helps you with that. That should answer that question. Now, when I go to the hour, this is where we were talking about the swing of the market, the swing of the market. Now look at what happened. I'm in a buy. So this has not happened yet. So do not look for a red candle with a flat top, a PSR flip, and the stochastic. It hasn't happened yet. But it needs to look like it's going into, like it needs to look like it's about to sell. This one actually has some pullback. Something happened here. Was it news? Whatever it was probably news, because it's a spike. And I know they had news earlier today. But 9 times out of 10, this one was news, because this was a nice sell. So we're gonna just pretend like it wasn't news, and it's probably us a nice little correction. So what we want to do is recognize that this is at the 45-minute mark. We're not going to enter this trade right now. We're not going to do it because my swing of the market is in a buy. I don't want to enter. Remember, the higher time frames tell me where my market is going. My lower time frames tell me I can enter on that movement and grab my pips and cash out. Remember, it's about me building my wealth. I can do that by grabbing some pips and grabbing a piece of the market. My lower time frames is where a lot of the movement happens. My higher time frames is what the market is actually doing. My swing of the market is in a buy. I'm not getting in right there. We talk about some variations. This is not GBP. This is not one of them. So I want to wait. So we're going to wait 15 minutes because that's all it is when you look at the bottom. I wait those 15 minutes. I go, okay, I now have a red candle. I now know I'm back swinging. The swing of the market is in a sell. So I can enter that sell. When I do that, I enter that sell. I can grab my 10 pips and cash out. This is where your support and resistance lines, everything that we just went through, this is where that becomes important. 10 pips and cash out. 10 pips, you drop the 111 and the 222 in the chat, market execution, and then you modify with your stop loss and your take profit. You don't know your pip reaction time. Your pip reaction time, how long does it take you to enter the trade? So you're wasting pips. So 10 pips and cash out, you want to do that. But you see that support and resistance line, if you are doing anything more than that, because I don't care anything, it doesn't matter what's going on. Yes, Monique. So it doesn't matter what's going on. Look what's happening. It's going to pause at that support line. This is where it's important. So you want to understand 10 pips and cash out. Anything above that, you need to understand support and resistance lines. Your stop loss is above the PSAR. Your stop loss above the PSAR. PSAR is a reversal in the market. So just like we just talked about really quickly, because I'm out of time. So look at, to the PSAR is 7 pips. Do you see how so if I just go a little bit above the PSAR, that's only about 8 pips, 8 or 9 pips. I'm still not, on that risk management chart, it said I had 10 to 15. It said I had 10 to 15. So I'm still good. So when you ask the question about if I have a reversal, do I panic and get out of the trade? No. You set your take profit. Look right here. We had some correction. You ride the wave. It's still going down. I had some correction. You ride the wave. Put your phone down and ride it out. It's going to hit your take profit or it's going to hit your stop loss. If it hits your stop loss, you've used proper risk management. It will never, you heard that, right? It will never blow your account because you're using proper risk management. So you understand we will never win 100% because the market is not 100%. But what we're doing should give you the confidence to know that you are going to walk away wealthy as long as you follow proper risk management. That's why that was important today. I am out of time really quickly. Do I have any questions? I gave you a lot of information tonight and some homework. If you do not enter on the first candle, can you enter on the second? Make sure you follow the same rules and confirmation. And if you do miss the first candle, make sure, if you do miss the first candle, make sure you understand where your support and resistance lines is, or where they are. Make sure you understand those support and resistance lines if you miss that first candle. That's going to be very, very, very important, okay? So I think this is going to help. We're building from here, 2020. So ladies and gentlemen, you guys are so welcome. You guys are so, so very welcome. But I'm going to promise you, do not leave this call right now. Do not leave this call, because I have two things really quickly. This Saturday in Orlando, you want to make sure you come to Orlando. You want to make sure you get registered, because if you got value from this call, you're going to get value from being in Orlando. You're going to get value from being in a place, because myself and the gentleman that I'm about to introduce to you, we're all going to be there. Mr. Rogers, definitely the pastor Yolanda and Lester Axon. We're talking about battle ready. You definitely want to make sure you're in the place. So make sure you get registered. Make sure you get registered. This is somewhere you want to be. You want to be registered for this event. I promise you, Orlando, Florida, you do not want to miss this event. We are declaring war on poverty. So 1 million families. The way you got this information today, if you found value in that, you will find value in making sure you do whatever is required to make sure you're in Orlando, Florida. Once your mind is exposed, it cannot go back. And your family will thank you for it. We're going to show you how 2020 is your year. This is your year. We're not just going to say it, we're going to walk it and put it into action. So, as I stated, that's the first thing that I have for you. The second thing is the why behind the what, because it is now time for a talk with the finance doctor. This is your RX for Forex. The gentleman that I am bringing before you now, the gentleman that I'm transitioning this call to, this gentleman has his PhD in finance and economics. So it is so important that you listen, because he has 100% of the information. He is having a lot of fun, and he is helping a lot of people. And tonight, he is here to answer all your questions. So it brings me great pleasure to turn this call over to none other than Dr. Craig Bythewood. Dr. Bythewood, are you on the call?
Yes, I am, Miss Dyer. Let's do a sound check first of all. Please let me know that you can hear me.
Yes, I can. And
excellent, excellent. Okay, I would like to welcome everyone to our Tuesday night calls. This specifically is a talk with the finance doctor, your RX for Forex, where we have designed this call to take advantage of an opportunity to speak with someone who has an objective view of all of the personal financial products and techniques, skills, and strategies that we can take advantage of as we begin to open up our mindset and expand our ability to be abundant, our ability to walk in wealth. So in this session, we take questions on trading. Well, I am sitting at a computer with my internet and a brand new microphone. So if I'm breaking up, I am not sure what to say. Let me check my internet very quickly. And my internet is fine. So I'm not really sure what to say. Let me try something else. Okay, how do I sound now? Okay, excellent, thank you. Okay, so please let me know if there is any future issue with the call. This is literally a new microphone and a new camera. So, welcome to a talk with the finance doctor, our opportunity to be able to address conversations in the economic empowerment pie. What is the economic empowerment pie? Well, it is our opportunity to take the personal financial realm and expound it to one of my favorite Bythwoodisms. And that is, if you know what you are doing, you will always have a job. And if you know why you are doing it, you will always be the boss. So we want to be the bosses of this information. We want to put ourselves in a position where we truly take advantage of the opportunity that I Am Academy is giving us to participate actively and aggressively in this $6.6 trillion a day market, this over $11 trillion a day market if we add the cryptocurrency space. We want to be able to recognize that we have a very active, vibrant sub-movement beyond the I Am Academy, which is undergirding what we're doing as a company, and that is the Be Your Own Bank movement, which is all about us understanding the value of being in control of our own economic infrastructure. So to me, these 2 night-a-week calls are pivotal because they give us the opportunity to understand, learn, and internalize the entire economic pie. I know I say it every call, but for the 111s and the 222s, I need to say it. Personal finance is the only area of our society where 100% of the individuals who provide you the information about the products are the same people who sell you the product. That is an economic oxymoron. That provides an opportunity for the descriptions of the products, for the answers to your questions to be designed in a way so that they benefit the organization rather than you. I've been studying banks my entire adult life. When I earned my PhD in finance and economics at age 26, my dissertation topic was on bank mergers and acquisitions. I've had the opportunity to be a consultant for financial institutions multiple times in my adult life. So understand this very important Bythwoodic fact. I am not anti-financial institution. I'm pro-household. So what a wonderful opportunity we have to walk in the power of our unmuted microphone and ask some questions that can immediately add value to our lives. So on Thursday's call, this was the question that was asked. Once we begin, or let's change that. Now that we have begun to reach a new paradigm in our wealth building, now that we have access to more wealth, what do we do with our money? And when that very good question was posed to me on Thursday, I suggested that we wait until today so that I could devote a large, substantial amount of time to the answer to that question. Now, one of the things that I say to children, clients, audiences, anybody who will listen, is I talk about the fact that for us to walk in the law of attraction, for us to understand the way the universe works and to get the most out of it, it benefits us to speak about what we want rather than the opposite. Because literally the way the universe works, the way the world works, the way this realm of Earth works, this happens to be the only planet I've been on, but it probably works on other planets as well. Whatever you give energy to, whatever you give focus to, whatever you put your attention on, that is what you're going to get. So with that in mind, I've always been very aggressive about making sure that we talk about what we want. Where should we put our money? Where do we want to put our money? However, there's a spiritual concept called contrast. Contrast. Contrast is the principle where you have to first look at what you don't want. You have to first look at what you don't want so that you now have a laser-like focus of what you want. Just for a second, think about the relationship that you're enjoying right now. And think about all the relationships that you had prior to this one. And if you're not enjoying your relationship, that was my shout out for you to find a better one in 2020. Yeah, I said it. So bottom line, if we think about all of the relationships that we had up until this good relationship that we're enjoying, each one of them, you experience contrast. You were able to see something that you didn't like so you could know what you liked. You were able to experience something that wasn't your preference so you could choose the preferences that you're enjoying in this relationship. So I said all that to say this. Even though it is always my philosophy to speak, talk, and engage our focus on what we want, let's start this conversation of where we should put our money with something that's very, very congruent with the point I just made about the subjectivity of the individuals that share with us where we get our money from. The individuals that share with us which personal financial products we should engage in. The individuals that have an economic incentive to tell us what will benefit their organization rather than our household. So here's a statistic to begin this discussion. The number one place that is recommended by financial institutions to put your money in, the number one place that financial institutions recommend you put your money in is what is called a CD. Charlie David, a CD. A CD stands for Certificate of Deposit. Certificate of Deposit. Now, I really want you to walk away with the why companies or financial institutions want you to put your money in CDs, but I also want you to walk away with why the finance doctor, Dr. B, is so adamant about, in being our own bank, we choose an alternative to CDs of where we put our money. Now, I specifically started off with this stat on purpose. It is the number one recommended place for you to put your money. But I also want you to understand that it is also the number one place where individuals put excess money. And I think those are two different things, and I wanted to make that distinction on purpose. The number one investment vehicle suggested by financial institutions, CDs, Certificate of Deposits. The number one place where individuals put their money, CDs, Certificate of Deposits. Now, to really break this down, let me give you another distinction that we need to walk away understanding. There are literally two types of markets that you can put your money in. There are two types of markets that you can put your money in. One type is a long-term vehicle. A long-term vehicle is a vehicle that is designed for you to put your money in for a long period of time. The second type of vehicle is a short-term vehicle. A short-term vehicle is designed for you to put your money in for a short amount of time. Now let's put some labels on these two markets. Long-term, the capital market. The official definition of the capital market, be your own bankers, the official definition of the capital market is an investment vehicle whose time period is 1 year or longer. The short-term investment vehicle market is called the money market. The money market. The definition of a money market is any place you put your money, any set of investment vehicles whose maturity or whose time period are 1 year or less. Makes perfect sense. Long term, 1 year or higher. Short term, 1 year or lower. So let me throw out let me throw out some capital market items so that we're comfortable with how this description matches with the knowledge base you brought onto this call. Stocks, bonds, retirement plans. These are all considered capital market items. They're designed for you to put your money in and keep them for a long period of time. Now, this would be a great time for me to pause and tell you how blessed you are that in this Be Your Own Bank movement, you have the opportunity to actually trade on a daily basis, on a minutely basis, on a 30-minute basis, on a 15-minute basis, these type of capital market securities. But what we're talking about right now is, where do you put the money? Where do you place the money? So I'm telling you now, there are two types: capital market, money market. Very easy for me to explain capital markets. Now, money markets, a little bit trickier. Money markets are a little bit trickier because there may be some items that are money market instruments that you may have never heard of. Things like, let's say, bankers' acceptances, or commercial paper. And for the purpose of this discussion, the definitions really don't matter. And later on, you'll understand why they don't matter. But I'm just throwing out there that there's some money market instruments that you may not have heard of because they're mostly used by institutional investors that have to park their money for a short amount of time. They're really not relevant to us, and I, again, will explain why later. But one such money market instrument is called you may have heard of it, a CD, a certificate of deposit. Now, I love the fact that in my academic life, I did the same thing that most people do when you study. I memorized and regurgitated. But because I memorized and regurgitated so I get good grades on tests, just like everybody else, I walked away with an advanced degree at 26 years old. It sounded good, it looked good. People give me respect because of the degree, but I am very comfortable in letting you know that my knowledge base was here and my credential was here. Why was your knowledge base so low? Were you not studying, Dr. B? I was studying. But you know as well as I do, the educational system is designed to give you short-term information, and it's designed to study theoretical scenarios instead of practical ones. I just said something. So I had to take action steps on my own to make my knowledge base make my credentials or meet my credentials. So I said all that to say this. I did not know or realize that there was anything wrong with CDs. I knew, just like you did, or you know now, that CDs were the #1 recommended place to put your money by financial institutions. I knew that the #1 place for people to put their money in the money market is actually #1 out of both markets. But I didn't realize a particular thing about CDs until I was teaching something. And when I was teaching a class and I was studying the formula for a CD, something hit me. I'm explaining it that way on purpose. Because one of the ways in which we be our own bank is when you walk away from this call, when you're in life and when you're dealing with financial institutions and you're thinking about the concept I'm giving you, you'll think the way I thought that day, and that is going to make you uncover some of the scenarios that we may not get to talk about because maybe it doesn't come up until 6 months from now. You know, there's something new. There's some new financial vehicle we don't even know about. So there's no way for me to talk about all of them, but there is a way for me to give you the perspective, the conceptual understanding of being your own bank, so that when you see the new vehicle, you'll be able to approach it with the same way in which I approach CDs. Here's my point. Write this down. And I guarantee you after you write it down, you'll never use it again. I'm just asking you to write it down so you can follow my story. I'm going to give you very quickly the definition of the formula of a CD. The formula of a CD. So all you have to do on your paper is write down the word, the letters CD. See, this is easy, isn't it? Then I want you to write two little horizontal lines that we call equal sign. CD equals. This is so easy. Now, I want you to write 4 acronyms on the other side of the equal sign. So CD equals. The first acronym, letter I, letter P. Igloo Peter, IP, IP. Then I want you to do a plus sign. And then I want you to write MP, Mary Peter, MP. Then only 2 more, we're almost finished. Then I want you to do another plus sign. I want you to write down DRP, Dove, Ricky, Peter, DRP. And the last one, we're almost finished, plus LP. Larry Peter. Now, hear me. These are the components of a CD. In other words, when you invest in a CD, each one of those P's stands for premium. Premium. Earlier today, we talked about 3% rate of return. That's a premium. If you go on a plane and you get a regular seat, there's a particular price, but if you get first class, it costs more. There's a premium. So all I'm saying is the P in all 4 of these components of the CD stands for premium. Roll with me, because I promise this little exercise will give you a conceptual understanding you'll have with you forever. Now, CD equals IP plus MP plus DRP plus LP. Now here's how it works. I stands for inflation, inflation, inflation. Inflation means that prices go up over time. Real simple. If I give you my money and then you give me the money back, I need to be compensated for the rise in prices. So inflation premium just means the higher the interest rates are, the higher the inflation should be. Or let me say it a different way. The higher inflation is, the higher the interest rate should be, so I'll be able to get my money back. The next one is called MP. M stands for maturity. I just told you there are 2 maturities. There's one that's long-term, one that's short-term. Real simple. When you invest in anything, the longer you're without your money, the more you need to get paid. Perfect example. What if IBM had a 10-year bond? And what if IBM had a 30-year bond? Which one should pay you more interest? The 30-year bond, because you're without your money longer and there is a longer maturity. This conversation is not just about answering this question. I'm giving you the arsenal and the tools you need for any conversation you ever have with those financial institutions in the future. You'll understand the underpinnings of it and you'll be able to speak what's best for your household. The third variable, DRP, DR stands for default risk. You guys know this one. If your credit sucks, you pay more interest. If your credit is better, you pay less interest. So far, this is so simple. The first one says higher inflation, you should get a higher rate. The second one says if you're without your money longer, you should get paid more interest. The third one says if your credit sucks, then you're gonna have to pay more interest. Or the other way around. If you're investing in something where the default risk is higher, you should get more risk. And by the way, You should get more return, excuse me. By the way, here's another shout out. We're in an opportunity to participate in a $6.6 trillion industry where risk doesn't matter. We don't care what the default risk premium is because all we got to do is use stop loss. I hope you realize that this whole paradigm that I'm telling you about, we get to circumvent all of it because we use proper risk management. We can invest whatever we want to invest, and the default risk premium is eliminated because we have a stop loss. The last variable stands for liquidity. Liquidity. Liquidity means how quickly can you convert your money to cash? How quickly can you convert your money to cash? Now watch this, because this is the only one that's inverse. If a market is more liquid, it's safer, so you get less interest. If a market is less liquid, it's more risky. It's harder for you to get rid of your security, so you should get paid more interest. It's the only one that's inverse. Here's my point. Here's my point. If you invest in a certificate of deposit at a small credit union or a state local bank, you'll get, numbers don't matter here, just concepts. You'll get about this much interest. But if you invest in the same CD at a big bank, you'll get this much interest. So that much interest with a big bank, with a small bank, this much interest with a big bank. Now, CDs at small banks have a shorter time period. Well, if you invest your money in something with a shorter time period, you should get less. But you actually can get more because it's a small bank. So I said all that to say this. CDs have such low rates. If you invest in a CD right now, that's a 2-year CD at a Bank of America, you're going to get paid about 1.2%. 1.2%. If you invested in a checking account that paid interest, you're going to get about 1.1%. Wait. What did you just say there? You're telling me that if I put my money in a savings account at a small bank, I can get 1.1%? But if I put my money in a 2-year CD and I don't get my money for 2 years, I'm only going to get 0.01 more? So the issue here is this. CDs by most banks are put with long-term periods like 1 year, 2 years. They even have a 5-year CD. But the interest rate that you earn on the CD from the big bank, you can get the same thing on a savings account rate at a small bank. This is not about being in small banks. This is about the fact that CDs are supposed to compensate you for being without your liquidity. They're supposed to compensate you for having larger maturities, but they aren't. Test me. Get off of this call, Google CD rates for 5-year, 3-year, 2-year rates for big banks, and then Google savings account rates for small banks, and you'll see they're the same. When can you take your money out of a savings account? Anytime you want. So what's the maturity? 0. When can you take your money out of a 5-year CD? In 5 years. When can you take your money out of a 3-year CD? In 3 years. And here's the real thing about it. CDs are designed to make you think you want to put your money away for a long period of time, and you're not compensated with higher interest. So guess what happens? Something happens, you need surgery, you want to open up a business, so you go and get your money out, and guess what they do? Boom. They hit you with the prepayment penalty. I'm sorry, they hit you with the early withdrawal penalty. So I started this conversation off to make one point and one point only, and that is, we do not want to put our money in CDs because banks are so gangster. Banks are so thugged with theirs that they totally ignore that formula, and they make you take away your liquidity and have a higher maturity, and they don't even compensate you for it. Now, having understood that, let me add another layer to this. I told you before that there are 2 markets, money market, capital market. One of the things that banks are really good at is they want you to invest in one of their products. And their second most sought after product in terms of selling it and in terms of investing is the money market account. Listen to that third word, money market account. They call it money market account on purpose because we know if we want to be able to put our money somewhere for a short amount of time, we want to be able to put it in the money market. So they call it a money market account. A money market account is a very high balance account, like $10,000, $20,000, $30,000. And they pay you an interest rate, which is only infinitesimally more than a savings account rate. But in order for you to get that rate, you have to keep the $10,000 in at all times. That's gangster. That's gangster. So a money market account, listen to that third word, a money market account is a bank product where they want you to put large amounts in. But remember earlier today, I told you that it doesn't really matter whether you know all the different types of money market vehicles. I said that for this reason. There's something called a money market mutual fund, a money market mutual fund. And a money market mutual fund means it is a mutual fund that you can invest in money market instruments. But guess when you can take your money out? Anytime you want. So why would I put my money in a money market account where I have to keep $10,000, $20,000 in and earn one rate from one bank, or put my money in a CD where I have to wait 2-3 years and possibly pay a prepayment, a early withdrawal penalty, when I can instead invest in a money market mutual fund, which invests in the same type of vehicles, but it invests in several of those vehicles, so it's diversified. And when can you take your money out? Anytime you want. So this is going to be a two-part call. But in part one, we've broken this down. That is the fact that what we're saying is that we want to go against the grain of what they want us to do. They want us, that is laughable, thank you, Merv. They want us to put our money in their products, which is a CD or a money market account. But in part two of this conversation, we're going to get a little bit deeper on places we can put it, but there's a very good first vehicle, a money market mutual fund. Now on Thursday, I'm going to go a little bit deeper to make sure you understand what a mutual fund is and what its purpose is, so we can compare the money market mutual fund to the capital market mutual fund, and I will address Bitcoin as promised. But for now, in contrast, we want to understand this. We want to understand the fact that where banks want us to put the money is in direct contrast to the best place for us to put our money. I am not anti-financial institution, I'm pro-household. So quick recap, they want us to put it in CDs. It's the number one place where we put our money, but because, as someone just put in the chat, we're woke now because we're being our own bank, that's the last place we'll put our money. The second place they want us to put our money in is a money market account, which is a bank product, one bank. But we recognize now, with further details coming up later, that a money market mutual fund allows us to invest in all of the money market instruments, but we can take our money out anytime we want. So again, this is part one of this conversation of where do we put our money. And what I'm hoping happens is that when we finish this conversation, it's going to uncover things you never thought about, and we'll continue to walk in the power of the unmuted microphone, and you'll ask even more questions so we can really begin to, for 2020, develop our vision of understanding how to manage our money, because we're already there. We already have the vehicle to improve where we're going. Now we can put ourselves in a position of managing it better. Merv, you are very welcome. I hope that you can, I know that you will continue to show up for part two and beyond. This has been a talk with the Finance Doctor. We, of course, will see you tomorrow morning at our 5 a.m. call. And I look forward to finishing this conversation up. Let me change that. I look forward to continuing this conversation on Thursday, because we want to be open-ended for whatever happens. And I want you to, you're very welcome, Monique. I want you to enjoy the remainder of your Tuesday evening. And I want to remind you that if you are anywhere in the vicinity of Orlando, you need to be at this event on Saturday, because we are going to bring the 2020 vision to an even deeper and greater passionate extent than we are right now. Okay. Mr. Rogers, there we go. There's our flyer. So Be Your Own Bank Expo, we want to be battle ready for 2020. I hope to see you in the place, because my face will be in the place, taking up space. See what I did there? Y'all know I was a poet. All right. Thank you for those fake laughs behind those muted microphones. And I will see you guys tomorrow at 5 a.m. Enjoy the rest of your evening, and 1 million families by 2021. All right, take care.